What the heck is happening with interest rates? Interest rates have really set the tone for 2022's marketplace. Stocks, bonds, real estate, everything has been all about the explosive rise in interest rates. What the heck happened and what do we need to look out for moving forward? That's exactly what we're going to go over today, and what I think in order to have the proper frame of reference is what actually influences interest rates and what should we look out for moving forward. So let's get into it. What the heck is going on with interest rates? Because in 2021, it was really a banner year for real estate. They were projecting more of the same. We had over 20% of an increase in appreciation in just 12 months. And the 30-year fixed rate mortgage was the lowest in recorded history, or at least it was. We really ended the year hovering right around 3%. And back in December of 2021, everybody thought that it was going to continue to remain low, with only one brave soul, the Mortgage Bankers Association, having the fortitude to think maybe it might hit 4%, but not until the fourth quarter or the end of 2022. So what actually happened? Well, they were right. We did hit 4%, but back in March 15th, and we kept going on from there. So what the heck happened? Short answer is the Fed happened. Now, the main message I want to get across to you today is that the market moves in anticipation of what the Fed will do, not just in response to what the Fed actually does, because a lot of people are talking about, oh, the Fed's going to be meeting at this such and such date and they're going to raise it another 75 basis points. So that means interest rates are going to go up another 75 basis points. If everybody thinks that's what the Fed's going to do, that's already been priced in. It's just a matter of if the Fed does something different than what people are anticipating, that's when there's a shock to the system. So let's actually do a quick story time into what the Fed actually does. What is the Fed and what does it do? Well, if you take out a dollar bill, or in this case, $100 bill, and you look up in the top left-hand corner, you'll actually see it'll say Federal Reserve Note. That's because this actual private institution called the Federal Reserve is tasked with both public and private mandates, one of which is conducting the nation's monetary policy. They are allowed to actually create money, and then a number of additional things that are beyond the scope of this video. But the most important thing when it comes to this video itself is what's called the dual mandate, where what they are in charge of is this delicate balancing act between price stability, or inflation, on how quickly prices are rising, or deflation, how quickly prices are falling, and what's called maximum employment. So let's get into what those actually mean. So for the longest time that the Fed has sought to achieve a 2% inflation rate, but back in 2020, they added an additional phrase, says over time, because as they were projecting inflation to begin to increase, they were hoping to save themselves by having a more longer term average feel. So they're seeking 2% inflation over time, where maximum employment actually doesn't have a solid quantifiable number associated with it. They factor in a whole bunch of other things, but they're seeking maximum employment based upon the current economic factors of the country. So again, in summary, the Fed's goals are 2% inflation over time and maximum employment. So how the heck is that actually going? Well, let's take a look. The Consumer Price Index, or what's called the CPI, or another way of saying inflation rate, is at a 40-year high at just over 9%. And for the first time since the 80s, we are actually having an inflation rate that is above the unemployment rate, which is the first time since the stagflation era of the 1970s and the double dip deep recession of the 1980s. A horrible time to be comparing ourselves to. We're also seeing articles that this is the worst year since 1939 in stocks, and if you look at a heat map for what stocks have been doing so far this year, it is sea of red, with the exception of if you were in healthcare or possibly energy. And the crypto market isn't looking any better. There's really been an implosion in the crypto market, and we're starting to see national and local headlines saying don't buy a house, the market's cooling off, deceleration's happening, and all of that. So what the heck can the Fed actually do? Well, the Fed really has two main tools to really control its dual mandate. Number one, setting the federal funds rate. And number two is quantitative easing or quantitative tightening, depending on which ones they choose to do. So what the heck is the federal funds rate? Because we keep hearing them saying that they're setting the interest rate at X%. That's not the mortgage rate. The federal funds rate is what commercial banks borrow and lend to each other as well as to the Federal Reserve. It does not set mortgage rates. So just because they're going to set an increased amount at the federal funds rate does not mean that the interest rate for mortgages will be going up that exact same amount, although it can have influence over the mortgage rate. If you want to have a closer attention to what mortgage rates are actually going to do, over the last 50 years, the 30-year fixed rate mortgage has moved in unison with the 10-year treasury rate or the 10-year treasury yield. There's been an average spread of 1.7% between the two, but what's most important is the direction. When the 10-year yield goes up, generally rates tend to go up as well. So when the 10-year yield goes up, so too do rates. Generally, when the rates for the 10-year yield go down, so too do interest rates. So let's talk about what actually has control over bond yields. That gets more into quantitative easing, which what the heck is quantitative easing? That is when a central bank, this time being the Federal Reserve, actually purchases long-term securities from the open market, meaning they physically go out and buy assets. And that serves to lower interest rates by bidding up fixed income securities. Don't worry, we'll go over that. That sounds like a whole different language, which don't worry, we'll cover it. And quantitative easing increases the money supply by purchasing assets with newly created bank reserves. What that means is that the Federal Reserve is allowed to create its own money out of thin air, because that's one of the things that they're tasked with doing, and they're also allowed to purchase assets. Or another way of saying in a meme fashion, the Federal Reserve go burr. So what quantitative easing, another way of saying it, is as the Fed buys longer term bonds and mortgage-backed securities, it drives down yields, which in turn puts downward pressure on interest rates. The reverse, quantitative tightening, is as the Fed sells its longer term bonds and mortgage-backed securities, it drives yields up, which in turn put upward pressure on interest rates. Another way, when the Fed buys, yields go down. When the Fed sells, yields go up. But because yields are synonymous with interest rates, when the Fed buys, interest rates go down. When the Fed sells, interest rates tend to go up. And we can tell what the Fed is doing by taking note of the Fed's balance sheet, as it's called. So as you can see, really until a specific time frame, it was hovering just under $1 trillion. And then all of a sudden, in September of 2008, it shot straight up, going from 9.25 billion to 2.2 trillion with a T in 60 days, which was nearly 2.5 times its balance sheet in just 60 days. So what the heck happened in September of 2008? As we remember, the financial crisis happened, and as you can see here, it reached its climax with the bankruptcy of Lehman Brothers on September 15th, 2008, coinciding directly with when it exploded its balance sheet. And what happened during that time frame? The stock market dropped by over 50%. The housing market dropped for one of the first times in history, an astounding nearly 20% on a national basis, but some areas 50, 60, 70% reduction in real estate prices. All of a sudden, holy crud, the unemployment rate shot up to 10%, and consumer price index, or CPI, or inflation, not only dropped, but actually went negative. So it wasn't just that the rate of increase slowed down, prices actually decreased. So that's how they began to call this a deflationary crash, because everything went through the floor. So price stability wasn't the issue because prices were actually falling. So their sole purpose was to ensure maximum employment. So what the heck did the Fed do? They dropped the federal funds rate to basically zero. They exploded their balance sheet by by nearly 2.5 times. So what did that do? It put downward pressure on the 10-year treasury yield, which put downward pressure on the 30-year fixed rate mortgage, and that created a nice steady 8-year recovery in real estate prices. Not only did it do that, but it dropped steadily the unemployment rate, and even better than that, the consumer price index stayed relatively flat. So that to me is a pretty successful recovery. Now the question is, how could they unwind that balance sheet and how could they come back to a more neutral rate? Because it wasn't sustainable to keep rates at zero. So back in January of 2017, they began to systematically raise the federal funds rate, and beginning in 2018 actually began to reduce their balance sheet, which they called the Fed taper. So what did that do? Because they started to sell off their balance sheet, that puts upward pressure on treasury yields, which puts upward pressure on 30-year fixed rate mortgages. So they steadily increased from January of 2018 to November 15th of 2018 of a full percent increase in the 30-year fixed rate mortgage, which was the first time it had approached 5% since the Great Recession. And then California had its worst housing slump in over a decade, and they began to call this they began to relate this to 2007, and they called this the Taper Tantrum. Stocks went crazy. Real estate started to plummet in terms of transactions, not prices, but transactions were the sales slump. So the Fed actually paused its increases in January of 19, but by then a lot of the damage had been done, where they actually in March started talking about the yield curve had inverted. What does that mean? Don't worry exactly, but the number one thing is it was considered one of the most reliable recession indicators. There was a lot of news, a lot of craziness going on about an upcoming recession, and they again relating it to the first time since mid-2007 that this yield curve had inverted. So what did the Fed actually start to do? Not only did they pause their interest rate increase for the Fed funds rate, but they actually began to drop that rate and start to rebuild their balance sheet or buy more long-term treasuries and mortgage-backed securities, which again put downward pressure on interest rates. So by August, we actually began to see home sales rise again. That this was ending 16 consecutive months of sales decline. That the housing market was getting back on the right track. We all collectively had a sigh of relief until coronavirus happened, the Rona, where there was the flash crash where the Dow dropped precipitously in a short period of time, that in basically a month, the Dow dropped 34.78%. Pending home sales plummeted, and all of a sudden the unemployment rate went from a record low 3.5% to a skyrocketing 14.7%, which was actually the highest that you can actually find on the Federal Reserve's website. But the unemployment rate went through the roof, but still the CPI, Consumer Price Index, was relatively low and flat. So again, the Fed didn't so much care about price stability, it cared about maximum employment. So what did they do? The things they know how to do, which is plummet the Fed funds rate and skyrocket again over $3 trillion on their balance sheet in 4 months. and skyrocketed the M1 money supply by 4 times in one single month, injecting all of this liquidity directly to the consumer's hands, not into banks to then disseminate it down. So the Americans were flushed with money for the highest rate in recorded history of the personal savings rate, because all of that money got shot directly to consumers, not an intermediary of the bank. And what did that do? The unemployment rate steadily dropped. The Dow had the NASDAQ had the strongest recovery in history, and the 30-year fixed rate mortgage plummeted to the lowest ever in historic records. And of course, pending sales shot through the roof. It was a huge rebound effect where the active inventory homes available on the market that usually hover right around 1.3 million, depending upon the time of year, steadily dropped because of how many people rushed to take advantage of those historic low interest rates. So not only did the housing prices recover, but compared to the great financial crisis recovery, it was an extreme acceleration of the COVID recovery in terms of the housing price index. And the consumer price index, which started off relatively stable, quickly got out of hand to being over 5% in June of 2021, which was the first red flag that something was different this time. But still, at that time, the Fed kept the interest rate still at basically zero, and they were continuing to increase their balance sheet every single month, because the Fed's word of 2021 was it's transitory, meaning it's going to go away on its own. We're going to let things run hot for a little bit because it's going to go away, and we're searching for a 2% over time long-term average, until 5 months later it kept going up. So the Fed Chairman Jerome Powell finally said, hey, I think it's time for us to retire the word transitory and try to explain more clearly what they mean. By December of 2021, it continued to go up, and the unemployment rate continued to go down. So for the first time in a long time, they didn't so much care about maximum employment because it was some of the lowest in history. They now had sole focus on price stability. So what did they do? In December, they came out and said that they're setting the stage for earlier and faster interest rate hikes as inflation was continuing to go up. And just the prior month, they had said that they were set at keeping interest rates near zero. So what does that mean? That's a change. Anytime that there is a change in how the Fed operates, that freaks people out. And it was now forecasting not only that they were going to start to increase them, but they were now forecasting 3 interest rate increases for this upcoming year. And you can even see it was a major shift from the last time that they were split on even needing to do any of them at all. But not only were they saying they were going to increase 3 times of the interest rate of the Fed funds rate, but also that they were going to reduce their balance sheet. Remember, when they sell their balance sheet, that puts upward pressure on rates. Again, the market expectation was currently that the Fed to start raising its interest rate beginning in March, and that they were starting to do their runoff faster than was previously thought upon. And already on that news, government bond yields began to already rise. Because again, the market moves in anticipation of what the Fed will do, not in reaction to what the Fed actually does. So what started happening? Again, this article came out January 5th. Right from there, if you look, what actually started to happen? The peak of the S&P 500 was January 4th, because once that article came out, the market knew this was a change. All of a sudden, PE ratios were going to have to start dropping because money was going to get more expensive. So that was the peak of the marketplace right at that article, because that was when the market knew the Fed was changing. So right from there, from just the original news from the Fed in December to that, when that article came out, the interest rate of the 30-year fixed rate mortgage already started to go up on just that news alone. And the Fed hadn't even done anything yet because it moves in anticipation. And the Fed was still continuing to buy and increase their balance sheet every single month during that period of time. But already by when the Fed was scheduled to actually meet and increase the federal funds rate, it had already gone from 3% up to 3.85%. And that was right when they began to actually increase rates, because it moves in anticipation of what the Fed will do, not in a response for what it actually does. But what also happened at that March meeting is that not only are they're gonna hike interest rates, but now they actually see 6 more interest rates ahead, not just 3, by saying that it's a more aggressive path, and the rates coming at each additional 6 of the meetings coming in there. And it's a full percentage point higher than what they were talking about in December. So what does that mean? That's a change. The market doesn't like the change. So that was by March 15th, we hit 4%. But once that meeting came out saying that things were going to get more substantial and more serious, by April 14th, we were already at 5%. And if you notice, the rate of change was significantly higher. But then things started to level off in the month of May to June. Why is that? Because the CPI data came out that there was actually a reduction in the CPI in April. So everybody held their breath and said, is this maybe peak inflation? Until May came out and it actually ended up being higher. So what happened during that time? All the markets traded sideways. There was basically a 0% change in the S&P 500 during that period of time, staying neutral until the Fed met in May saying that they were going to go further than the market anticipated. Now they weren't going to be doing 25 basis point increase. They were actually going to double it up and bump it to 50 basis point increases. So as a recap, they said in 2021, no increases needed, it's just transitory. September, they reiterated, well, at least we're not going to do anything in 2022. And then November said, okay, well, maybe it's not transitory. December, they said, okay, we're going to actually increase it in 2022, but it's going to be 3 increases. Then January, they said, hey, we're definitely going to increase it 3 times. In March, they said, just kidding, we're actually going to do it 4 times. May, they said, and those interest rate increases are going to be bigger, 50 basis points. And then June, they came out and said, hey, it's going to be even bigger at 75 basis points in June. And again, because the market moves in anticipation of what the Fed's going to do, starting in June, interest rates started to explode up even higher from there. So the question is, where will we go from here? I can't say it better than this. Is that Len Kiefer, the deputy chief economist at Fannie Mae, mortgage rates are likely to continue higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. Much of this increase in rates in early 2022 was in anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. And here's the big one I want everybody to take home is until inflation peaks, mortgage rates won't either. And without an improvement in inflation, we don't know where interest rate ceiling will be. I know this was a long video. I hope that you took away what to look out for interest rates, what to keep watch on. The number one thing is to watch inflation, that interest rates will remain elevated until inflation begins to come down. So keep your eye on the monthly data that comes out every single month on the CPI report, the consumer price index or inflation rate, because once that begins to consistently go down, that's when we will begin to see the interest rate begin to decrease. So I hope this was helpful. I know this was a tall drink of water, but I hope it was helpful in helping you understand what's to happen and what's to come. I'm Jacob Lawlor, and I'm committed to your success.